Welcome back to the deep dive. So, today we are shifting gears a little bit. We usually look at the shiny stuff, AI, new tech, big historical events.
Right.
But today we are looking at a machine. And it's not a car, it's not a computer, it's a financial machine. We are looking at the mutual fund.
It is absolutely a machine, and it's one that a huge portion of the population uses. It's probably the most common financial tool in any modern household.
But do people really get it?
Well, that's the thing. I would argue very few people actually understand how the gears turn inside that black box.
I think that's totally fair. I mean, the common confusion, and I am definitely guilty of this, is treating a mutual fund like it's a single product. Like buying a stock or a bond, you say, I bought a mutual fund, the same way you'd say, I bought an iPhone. Like, it's a thing.
And that is the fundamental misunderstanding right from the get-go. A mutual fund isn't the destination.
It's the vehicle.
It's the vehicle. Exactly. You don't buy the bus, you take the bus to get somewhere.
Right. And to understand this vehicle, we are going straight to the mechanics manual. We are looking at the NISM Series V-A Mutual Fund Distributor Certification Examination Workbook, specifically Chapter 2.
I know. It sounds incredibly dry. It sounds like a textbook you'd use to prop up a wobbly table.
It does have that vibe, yeah. Series V-A certification.
But if you think about it as the actual rule book, the blueprint for how this massive industry works in India, it becomes genuinely fascinating. This tells you where the money actually goes.
And who really owns it?
And who owns it? And what happens when things go wrong?
So that's our mission today, to decode this machine. We want to unpack what a mutual fund actually is, legally, how it operates, and why it's become such a dominant force in the economy.
Then we are definitely going to have to bust some jargon along the way. Chapter 2 is full of it.
Oh, absolutely. So let's start with that aha moment I had right at the start of the chapter. The text makes this very specific distinction. It says you don't invest in a mutual fund. You invest through one. That feels like splitting hairs, right?
It sounds like semantics, but it is the absolute core definition. I mean, if you grasp that one concept, you grasp everything about the safety and the structure of the whole industry.
Okay, so unpack that for us.
Well, when you say you invest in a company, say a big name like Reliance, you're buying a piece of that company.
Yeah.
You own equity. If that company goes bust, your money goes down with it.
Right. That makes sense. Your fates are tied.
But a mutual fund, structurally, is a trust. It's a pass-through vehicle set up to mobilize money from lots of investors.
So when you say trust, you mean that in the legal sense, it's not a corporation?
Exactly. This is the part people miss. The fund itself is a trust, established under the Indian Trusts Act. The money you invest doesn't belong to the asset management company, the AMC.
The people running the show.
Right. They're just the hired help. They're the driver of the bus.
Yeah.
And the bus itself and all the luggage inside, which is your money, that belongs to the trust.
That's a huge distinction. So let's play out a doomsday scenario here. If the AMC, the fund house, if they go bankrupt, my money isn't on their books. Creditors can't come after my savings.
Precisely. They cannot touch the passenger's luggage. The text is very clear on this. The profits belong to the investors, the unitholders.
But there's a flip side to that, isn't there?
There is. And this is the other side of that pass-through coin. The losses also belong to the investors.
So they can't save me from a market crash.
No. They're a service provider.
Yeah.
Think of it like hiring a professional painter. You're outsourcing the labor. You aren't buying a different house. You're buying a different way of getting your house painted. If the paint peels because of bad weather, it's still your wall.
That makes a lot of sense. So I'm buying a service. Instead of me sitting there picking stocks and tracking dividends, I'm outsourcing that entire process.
The decision-making and all the administration, yes. But you always retain the ownership of the underlying assets. Now, the source material suggests this structure isn't just for individual benefit. It talks about a bigger macroeconomic role. It even calls mutual funds a market stabilizer.
It does. And this is where your personal savings connect to the national economy. The text explicitly says they provide a counterforce to foreign money.
Right. There was that specific example from 2022. It said foreign portfolio investors, the FPIs, were selling heavily.
They were dumping Indian stocks. And historically, when that much foreign money leaves the market tanks. Panic sets in.
But it didn't that time.
It didn't. And the reason was domestic money flowing into mutual funds. The mutual fund industry stepped in. They had all these fresh inflows from regular people, monthly SIPs, and they used that cash to buy the very stocks the foreigners were selling.
Wow. So it's like a giant shock absorber for the whole system.
It is. Millions of small, scattered savings get converted into this massive block of capital that provides stability. It makes the whole system more robust. Okay, so we have the legal structure. It's a trust. And we have the macro impact. Let's look under the hood. The text talks about every scheme having an investment objective, and it seems to be a balancing act between three things.
The iron triangle of investing: safety, liquidity, and returns.
And I'm guessing you can't have all three at once, like a perfectly safe, instantly accessible fund that gives me 20% returns.
If you find one, you let me know. I will quit my job immediately. No, the fundamental rule is you have to trade one off for the others. Every mutual fund is just a different recipe with those three ingredients.
The source gave some great examples. One that stood out was overnight funds. I'd never even heard of that category.
It's the extreme end of safety and liquidity. The objective is reasonable income with high liquidity. And to do that, they invest in things that mature in just one business day.
One day, they buy something today and it matures tomorrow.
Exactly. So the risk of anything going wrong is almost zero.
But the returns must be tiny.
Oh, they are. You're just parking cash you might need tomorrow morning. You're absolutely not trying to get rich.
And then on the total opposite end of that, you've got equity funds.
Right, where the objective shifts to long-term capital appreciation. The language is all about growth. So you're sacrificing safety for that potential growth.
Now, there was one category in the text that sounded like a hybrid. Target maturity date funds, or TMFs. The book says they solve something called reinvestment risk. What is that?
Okay, so this is a little technical but really important. Imagine you buy a bond that pays you 7% for 1 year. At the end of the year, you get your money back. Great. But what if interest rates in the market have dropped to 5% by then?
Then I have to take my money and put it into something that pays less.
Exactly. You have to reinvest at a lower rate. That's reinvestment risk.
Okay, got it. So how does a TMF fix that?
A TMF has a specific end date, say 5 years from now. The fund manager buys bonds that also mature in 5 years.
And just holds them. They don't trade in and out.
Exactly. They hold to maturity. So you effectively lock in the yield. If you stay till the end, you have a very predictable return. It minimizes that risk of having to reinvest in a bad market.
That's a pretty clever structure. So you have the objective, which is the what, and then the book talks about the investment policy. How is that different?
The policy's the how. If the objective is growth, the policy says, okay, to get that growth, we can only put, say, 80% in large companies and 20% in mid-sized ones. It's the rule book the manager has to follow.
So a manager of a safe debt fund can't just wake up one morning and decide to buy a risky tech stock.
Precisely. It prevents what's called style drift.
Which brings us to the accounting. Let's get into the nitty-gritty, because Chapter 2 throws around a lot of acronyms. Units, face value, AUM, NAV.
Let's strip it right down. When you invest, you're buying units of the scheme. Think of the whole scheme as a giant pizza. You're just buying slices.
And the text says the face value is usually 10 rupees. Is that the price of a slice?
Only at the very, very beginning, during the new fund offer. It's just an accounting starting point. The number that really matters is the assets under management, or AUM.
The total value of a pizza.
The total market value of the whole pizza, correct. And the AUM is constantly breathing. It's dynamic.
It changes with the market, obviously.
It changes in two ways. One, new investors bring in cash, the pizza gets bigger. But two, and this is key, if the stocks inside the fund go up in value, the AUM goes up.
The book also mentioned AUM falls when they pay out dividends, which I guess we have to call IDCW now.
That's right. Income distribution come capital withdrawal. It's a mouthful, but it's more accurate.
Why is it more accurate? Dividend sounds nicer.
Because people used to think a dividend was extra money, a bonus.
Yeah.
But in a fund, when they pay you that IDCW, the AUM drops by that exact amount. They're just giving you back a piece of your own capital.
That's a huge realization, I think. You're not getting a bonus. You're just cashing out a tiny piece of your slice.
Exactly. Which brings us to the most important acronym of all. NAV, net asset value.
The price per slice.
Price per slice. And this is where the concept of mark-to-market, or MTM, comes in. It's vital for transparency.
Okay, so what does mark-to-market actually mean for me?
In some investments, like, say, private real estate, you don't really know what your investment is worth until you try to sell it. You're just guessing.
Like my house. I have an estimate, but I don't know the real price until someone makes an offer.
Exactly. But with a mutual fund, thanks to mark-to-market, every single security in that portfolio, every stock, every bond, is valued daily at its closing market price.
Every single day.
Every single day.
Yeah.
The fund accountants take the total value of all the assets, subtract the expenses, and divide by the number of units. That gives you the NAV.
So the price you see is the real up-to-the-minute price.
It's the real price. It causes those daily ups and downs, which can be scary for some, but it means you are never guessing. It is the ultimate transparency.
That transparency is a huge selling point, which leads perfectly into the pros and cons. Why do this? Why not just buy stocks myself? The book lists professional management as the big one.
And it's not just about picking winning stocks. I think people really undervalue the administrative side that the book highlights, all the corporate actions.
Right. Dividends, rights issues, buybacks.
If you own 50 different stocks, tracking all that is a part-time job. A mutual fund handles all of it. It's the basic hygiene of investing.
Then there's economies of scale.
Simple purchasing power, right?
Yeah.
An individual with 5,000 rupees is a small fish. A fund with 5,000 crore is a whale. They get better prices, lower costs.
Here's one that really interested me, the tax benefit. The source mentions tax deferral. I didn't fully get this.
This is a massive advantage. So because the fund is a trust, it is not liable to pay tax on the income it earns internally.
Wait, so if the fund manager sells a stock and makes a huge profit inside the fund itself pays no tax on that gain.
Correct. As long as that money stays inside the scheme, it's tax-free. The tax liability is deferred until you actually withdraw the money.
And in a bank FD, you pay tax on the interest every single year.
Every year, even if you don't touch it. And that tax eats away at your compounding. In a fund, the money compounds tax-free until the very end. Over 20 years, that's a huge difference.
It really is. But okay, let's be fair. The text also lists limitations.
Absolutely. And one of the biggest ironies is choice overload. The whole point was to simplify things.
But now there are thousands of schemes. It's like the cereal aisle at the supermarket. You just freeze.
You do. It can lead to paralysis. Now, SEBI has tried to fix this with categorization norms so you can at least compare apples to apples, but it's still a crowded market.
And no customization.
Right. You are one of thousands of passengers. You can't call the manager and say, hey, I don't like that company's environmental record, please sell it. You go where the bus goes.
And the big one, no guaranteed returns.
We have to keep coming back to that. It's a pass-through. The risk is passed to you. If the market tanks, your NAV tanks. The fund manager still gets their fee, but you take the loss.
Let's talk about the different flavors, the classification. First, by structure. Open-ended versus close-ended?
Right. Open-ended is what most people know. It's a revolving door. You can buy or sell anytime. The key benefit is liquidity.
And close-ended?
That has a fixed maturity date. You can only buy during the NFO, the initial offer. After that, the door is locked until the end date.
But wait, the text says they're listed on stock exchanges, so can't I sell my units to someone else on the market?
You technically can. But hold that thought. There's a huge catch there we need to come back to.
Okay, we'll park that. Then there's classification by management style. Active versus passive.
Active is the classic model. The manager tries to be smart and beat the market. Higher costs for that. Passive just tracks an index, like the Nifty 50. It's robotic. Lower cost, no human bias.
Now, on that topic of passive funds, the source mentioned something very new, MF Lite.
Yes. This is a very recent development from around the end of 2024, early 2025.
What is MF Lite? It sounds like a diet soda.
It kind of is. It's a lighter regulatory framework.
Yeah.
SEBI basically recognized that passive funds carry less risk because there's no active stock picking.
So they don't need as much oversight.
Exactly. So MF Lite makes it easier and cheaper for new companies to enter the business if they only want to offer passive funds. It lowers the barrier to entry.
Which should mean more competition and hopefully lower fees for investors.
That's the theory, yes.
The text also categorizes by investment universe, mentioning things like real estate and commodities.
Right. You can have real estate mutual funds, infrastructure debt funds, and for commodities, the most common are gold and silver funds.
And the text says you can buy units that represent the physical metal.
Yeah. So instead of storing gold bars in a safe at home, you just hold a unit that represents that gold. Again, you're investing through the vehicle, not owning the raw asset yourself.
It really does come back to that every time, doesn't it? The fund is just the wrapper.
It's the legal and professional wrapper around the asset.
So if we zoom out, we've gone through the manual, we know it's a trust, we know about NAV and mark-to-market. What does this all mean for the person listening right now?
It means that when you invest, you're not just saving. You're engaging a highly regulated professional machine. You are hiring a whole team, accountants, analysts, traders, but, and it's a big but, you're accepting the machine doesn't promise a smooth ride. It just promises to drive according to the map you chose.
And you have to choose your map. Back to that iron triangle. Do you want the safety of the overnight fund map or the potential growth of the equity fund map?
Precisely. The mutual fund is a tool, not a magic wand. Understanding the mechanics helps you use that tool effectively.
I want to end on that thought we parked earlier, the one about close-ended funds. The source mentions that while they're listed on exchanges to provide liquidity.
Yes. The difference between theoretical liquidity and actual liquidity.
Exactly. The text explicitly says they often suffer from poor trading volumes.
And this is a profound point. Just because an exit door legally exists doesn't mean there's anyone standing on the other side waiting to open it for you.
So if you're in a close-ended fund and you have an emergency, you might see a price on the screen.
But if there are no buyers, or very few, you're stuck. Or you have to sell at a huge discount to the NAV just to get out. It really challenges the definition of liquidity. Is something truly liquid if you can only sell it at a big loss because nobody's trading it?
That is a provocative thought to leave with. The difference between what the rulebook says is possible and what the market actually allows.
Always check the trading volume, not just the listing status. The rulebook gives you the legal right, but the market gives you the reality.
That wraps up our deep dive into the machinery of mutual funds. We took apart the engine, looked at the gears, and hopefully now you have a better idea of what you're driving.
It's always better to know how the car works before you hit the highway.
Thanks for listening. We will catch you on the next